Welcome to our Investing 101 series for first generation moms. When I was 9, we moved from the Philippines to the United States, and while my parents worked hard to provide for us, I don't have the luxury of old money to fall back on. As a mom, I am investing for my own financial security as well as that of my family. Investing can be overwhelming. There is so much information and content out there that you can get paralyzed into taking action because you just don't know where to begin. This series is meant to break down the essentials of investing so that you can break through the noise and start investing for yourself, for your family, and build wealth. The full investing playlist can be accessed here as well as in the description. Now, I also want to note that I am recording the intro to this section of the Investing 101 series post-election. And I want you to focus on your own house instead of who is in the White House. What you do in your own house today, whether that's investing, getting out of debt, or teaching your kids money will pay off in the long run than whoever is sitting in the White House today. Also want to show you this graph of the S&P 500. S&P stands for Standard & Poor's 500 list, and basically it is a stock market index that tracks the performance of 500 of the largest companies listed on the stock exchanges in the United States. Companies like Alphabet, the parent of Google, Meta, who owns Facebook and Instagram, Apple, Coca-Cola, Exxon, McDonald's, Mondelez, who owns Oreos, Netflix, and so forth. Companies whose products you buy and use on a daily basis. And here is the performance of the S&P 500 against presidential terms. Note the increasing trend line of this index. This means that as long as you are invested for the long term, you will reap the benefits of investing. If you're ready to invest wisely without getting overwhelmed, let's break down the 6 things every beginner investor should consider before investing. Remember that investing requires that you lock away your money for a period of time so it can grow. We'll review what's in it for me, how to understand risk and return of investing, why investment liquidity matters, how much will it cost to invest, why diversification is important, how to avoid scams and protect your money, and lastly, how to figure out how much you can invest so you can get started right away. Our first item to consider is the risk and return of any investment. All investing involves risk, but there's a potential upside for higher return. Risk is basically the degree of uncertainty and or potential financial loss of an investment. With any investments, you as an investor will want to seek higher returns to compensate yourself for taking such risks. The greater the risk, the greater for a potential return. Keep this simplified view in mind as it will inform the way you will make your investment decisions. If you end up working with an advisor or a robo-advisor, they will ask you what your risk tolerance is, so that they can guide you and your investments properly. Risk tolerance is your ability and willingness to lose some or all of your original investment in exchange for potentially greater returns. Your appetite for risk will vary depending on your age, your financial circumstances, if you have debt, if you have children, and it may also change as you gain more knowledge and experience in investing. Depending on the type of investment you make, some will carry higher risk but higher potential return, and some will have lower risk but lower potential return. If you look at this chart here, we see that stocks and corporate bonds have a higher risk and higher potential return. Mutual funds, stocks, and bonds are not insured against loss in value, so they have a higher risk. Company stock can fluctuate up and down, and this volatility can be scary for investors. A stock's price can be affected by factors outside the company, such as political events or even market events, and a company can fail or go bankrupt, which means there's a lot of risk, but if they don't and they succeed, there's a potential for high return. On the opposite side are money in savings accounts, your CDs, money market accounts, and US Treasury bills. Your savings accounts and CDs are protected by the FDIC, and they're generally viewed as safe because they have that protection. Unfortunately, they don't have a high return as a trade-off. US Treasury bills are also considered safe because it's backed by the US government. Depending on your goals, you'll most likely want a mix of high risk, high potential return assets and low risk, low return assets, because you don't want to risk losing your money if you need it in the short term. An important thing to remember too is that over time, you will gain investing knowledge that will increase your investing confidence. This means that even as the stock market goes up and down, your time as an investor will provide you the experience to continue following your long-term investing strategy. Remember that the daily fluctuations of the stock market can be risky and is not for everyone. But if you zoom out and look at it from a long-term perspective, you will see a steady increase over time. Here's a snapshot of the S&P 500, which tracks the largest companies listed in the US stock exchanges. In one day, you will see large fluctuation. But let's compare that to the long-term trend. You will see an increase over a few years. For many of us, we will want our money to be part of this long-term growth. In this lesson, I've linked a quiz that measures your risk tolerance. This quiz was developed by two university personal finance planning professors from Virginia Tech and the University of Georgia. I recommend and encourage you to complete it as best as you can and review the results. This will inform the kind of investor you are and help you decide what type of investments to include in your portfolio. The second thing you'll want to consider when investing is liquidity. Liquidity is all about how easy it is to sell or buy assets when you want to. In order to sell your assets, you need to make sure there's a market of investors who can potentially buy what you're selling and vice versa. Today, electronic trading makes it easy to buy and sell securities, so liquidity is less of an issue, but there's still a risk that when you go to sell your assets, you end up selling at a loss. There's also liquidity in the form of products that have early withdrawal penalties, such as your CDs or your retirement account. With the case of retirement accounts, these can have fairly low liquidity because a few account types have penalties if you withdraw before a certain age. The penalties for these accounts can be pretty high when compared to the low-risk account. Here's a look at our return risk against liquidity and time horizon. So we know that we have a higher risk and higher potential return at the top, but this also means we would have a long time horizon and lower liquidity. On the opposite side is our lower risk, lower return, and shorter time horizon and high liquidity accounts to consider. The third thing you want to consider is investing fee. Investing does cost money, but when set up properly, you can reduce the fees you'll pay for your investments. Doing so means there'll be plenty more of your money to grow. There are two types of fees that you'll be looking for when investing. The first is called transaction fees, and this is the fee that's charged each time you enter into a transaction, like when you buy or sell a stock or a mutual fund. These fees may also come in the form of other transaction fees that come at the front end load or a back end load of certain mutual funds. The second type of fee are ongoing fees that are charges you incur regularly, such as an annual account maintenance, expense ratios, or investment management fees. Remember that compounding works both ways. It can help increase your returns, but it can also eat it up. Over time, even ongoing fees that are small can have big impact on your portfolio. This is an example of the magic of compounding returns, but also the tyranny of compounding costs. This is from the book by John C. Bogle. And if we look at it, if we have a investment growing at 8%, we have a trajectory to grow our money fairly well. But if we have a lot of costs associated with that and those costs eat up our investments and our returns, we end up with around $145,000. And look at the difference in those costs. So it's important that we keep in mind the cost of investing. And in a little bit, we will review how to look for those costs so you're aware how much you'll be paying in fees for your investment. In this lesson, I've linked a tool to help you calculate how fees will affect your investment growth. Take a look at it so you can use it when we complete some investment analysis later on. The fourth thing to consider when investing is diversification. You've heard of the phrase, don't put all of your eggs in one basket. The idea with diversification is to divide your investments across different accounts to increase flexibility and across different assets to reduce financial loss. To diversify, you'll want to spread your investments across different assets like stocks, bonds, or cash. By doing so, you will spread your risk and your return across different asset classes. Remember that risk tolerance is different for everyone, and therefore, asset allocation and the decision to spread your assets is a personal one. The allocation that works best for you changes at different times in your life, depending on how long you have to invest and your ability to tolerate risk. Factors to consider include your time horizon. How many months, years, or decades do you need to invest to achieve your goals? Those with a shorter time horizon may prefer to take in less risk so that you have more money available for you. Another key area to diversify is the types of investment accounts you hold, as they all have different tax treatments. By doing so, you set yourself up to take advantage of multiple tax treatments in case there's any tax changes in the future. The fifth thing to consider is scams and fraud. Unfortunately, there are scams and fraud in the investing world, and yes, it's possible to get scammed in this day and age. Financial fraudsters are sophisticated, And it's important to keep these in mind so that you can spot investment scams right away. Here's what you need to look out for. Be wary of offers that are too good to be true. Watch out for offers that promise extremely high returns with no risk. The second is look for unsolicited offers. Make sure you review investments and the credibility of those suggesting the investment. You can check out disciplinary history of brokers and advisors for free using the SEC and FINRA's online database. We'll also review that a little bit later when it's time to choose a financial advisor or work with a robo-advisor. And lastly is be wary of pressure to buy the product. Be aware of pitches that says everyone is buying it or the pressure to buy now or send money now. And lastly, you'll need to consider how much to invest. And this will depend on many factors. What your goals are, what your debts are, how much money you have available, and your age, and so on. It's important to keep the pillars of wealth in mind as you dive into investing. One is to optimize your expenses. Control your expenses and optimize it as much as possible, and work to reduce high interest debt. The second is to earn more. Negotiate to earn a higher salary or more benefits. And lastly is use the money that you are saving or earning more and invest the difference, the gap between your income and your expenses, and save that difference. Having your goals written can help you focus you and your money. Investing a few dollars a month early on not only gets you started with investing, but sets you up to build a habit of consistency. Figure out what you want out of life and map out how much it will cost and how much you will need to save and invest to reach that goal. In this lesson, there's a downloadable PDF you can use to map out your goals. I recommend spending time to download that PDF and write your goals down so that they seem more concrete and allow you to have a plan of action to reach them. Keep things in mind. What do you want to do with your life? What kind of life do you want for your future self? What kind of life do you want for your kids? What kind of life do you want for your community? How do you want to give back to your community? Put these on paper and focus on those goals. As you continue working on your investing muscle, check out this video to continue your investing education. And if you are struggling to figure out how much money you should be investing from your budget, I want you to check out this video. It has budgeting tips so you have more margin to use to save and invest. Thanks for joining me today here at Sisters for Financial Independence, where we cover topics related to money, motherhood, and everything else in between. Don't forget to like this video if you found value and share it with a friend, and subscribe for more money lessons. I will see you in the next video. Bye.